So let's have a look at what history shows us, and this gives us an idea of what a median home price was in Brisbane up until October 2011. So it was $420,000. Our All Ordinaries Index. So All Ordinaries Index is the top 500 companies listed on the share market, and is around 4,300 up until the end of September. So let's go back into history, and we'll go back to 1980. But before we do, we'll just do a quick trivia quiz here. So who can tell me who was Australia's Prime Minister in 1980? Yep, so it was Malcolm Fraser. Does anyone know what the interest rates were in 1980? So they're actually around 12%, and they would eventually get up to over 17%. Does anyone know what the exchange rate was for the Aussie dollar to the US? So it was actually $1.20, so we actually got more US dollars than ours. Alright, so who wants to have a guess at what the median Brisbane property price was in 1980? So the median price was actually $38,795. So it's amazing how quickly we forget about what happens in the long run, and we all get caught up with what happens in the short term. Now, if we have a closer look at that, do we think that we would have been worried that we were paying too much? Always. So let's pretend we paid $50,000 for that property instead of the $38,000. At the time, our family and friends would have been saying what a silly mistake we were making. But if we have a look at back now, we can see what such a smart decision that was. The timing's never ever going to be 100% right on buying assets. The important thing is that we're taking action with a long-term plan in place. Also, do you think that property would have seemed cheap at the time? No. So, property always seems expensive at the time, but cheap years later. And do you think there would have been lots of reasons not to buy at that time? Yep. Interest rates were very high. There was a recession coming. So there's always reasons not to buy, always. Now, can anyone tell me what the All Ordinaries was back in 1980? So it was actually 546. Now, both of these assets seem incredibly cheap years later. And if we think about it, the income that we've received from both of these along the way are coming up to what we paid for the investment. So it's pretty amazing. The message here, though, is that both are great, and both should be part of building in, your retirement nest egg. Trying to work out which of the two is better is a waste of time, in our opinion. It's like debating whether swimming or running is better for you. So we need to spend less time on the debate and more time on actually doing them. Now, this was a period of over 30 years, which sounds like a long time, but is anyone here not planning around to be here in 30 years' time? Now, if we have a look at inflation during the period would have taken that property up to 120,000 and just underneath 40,000, from 40,000 up to 120,000. Now, if we think about inflation, that's our biggest enemy we have to our retirement, and it's kept way ahead of inflation. Same with our share example. Just quickly before we go on, I just want to explain how retirement has actually changed over a couple of generations. Now, your grandparents would have started work anywhere between 15 and 20, and probably would have worked up until they aged 65 and then retired. So back then, their life expectancy was around to live to 72 years. So Dad would basically go to work for 50 years and then pass away after 7. So not much to look forward to, and not much need for any retirement planning. If we fast forward to today, many people we see want to stop work somewhere between 50 and 60 years old. So if we take 55, for example, now for somebody who's 55, there's a 50% probability that they're going to live well into their 90s, one person in that couple. So now we're talking about retirements of 30 to 40 years. So we better have some assets built up, and they better be some good growth assets, because 30 to 40 years is a long time to be poor.